Good morning, ladies and gentlemen. My name is Ryan Sutar. I'm one of the senior investment managers here at Sharewise, and we're here with Gregg Taylor, the Investment Director of Salto Brothers. Now, Gregg's been kind enough this morning to lend us his time and expertise in exploring Salto Brothers and specifically their SB2 Fund. So again, Gregg, thank you very much for your time. We'll just start things off with a fairly overview question. Can you tell me a bit more about the SB2 Fund? What's the structure and what assets do you guys look to invest in?
Yeah, thank you, Ryan. Good morning, everyone, and appreciate everyone taking the time to listen in this morning. So, Solder Brothers Emerging Companies Limited, under the ASX code SB2, is a listed investment company, and we focus on investing in emerging companies in the Australian market. So, I guess your traditional small cap equities, and we have a particular focus on companies with a market capitalisation of under 500 million. So, you should think of it as a diversified and actively managed portfolio of Australian small cap companies. Yeah, so if we think more a little bit about the assets which we invest in, is that we look to focus in more industrial and growth focused investments, and less exposure to the sort of resource sector.
Okay, well, thank you for that one. Now, can you just give us a bit of background, about the fund, where it's come from, where it's going to, and then just a bit of a track record from the investment team?
Yeah, absolutely. So, only recently the SB2 Fund passed our 3-year anniversary, which was a good milestone. It's what's pleasing is it's delivered positive performance during that time, and that's in an environment where the small cap market's been down over 10%. So the outperformance since inception's been double digit. It's at closer to 11%, north of 11%, and more specifically over the last 12 months, that strong performance has continued. So the investment team, we're very fortunate to have a large and experienced investment team, especially for a small cap fund manager. So we've got a dedicated team of 4 investment professionals solely focused on this product and fund, and I'm the portfolio manager and the head of the equity business. It might be real briefly just worth touching on my background. I have over 25 years experience in being an institutional investor in small caps in the Australian market. So, I was involved with, if I go through my background and where I spent a lot of time in the early part of my career was with a group called Schroders, which many of the viewers may be familiar with. So we had one of the first micro cap and small cap funds in the country. So that was in the early 2000s. So definitely a lot of experience in this sector, and been through many cycles and seen learnt many lessons, and which is great perspective as we sort of in this current environment. And but I'm fortunate to have a great team to support me. So I've got Tanay Matanda, who again 15 plus years experience in investments in the Australian market, and 2 senior analysts in the team in Francis Croswell and Keegan Colohan. Again, really instrumental players in making sure we do the proprietary in-depth research that we do in this end of the market.
Well, thank you very much for that in-depth look in. Now, we'll just remind participants that obviously if you have any questions, please do ask them through the Q&A function in Zoom. I've got a couple more questions here, but then obviously we'll open it up to the floor. Now, obviously, you've just discussed how small caps have underperformed over the past 3 years. Can you just give us a brief outlook over the sector moving forward? And realistically, do you think now is a good time to invest not only into the fund, but into small caps in the Australian market?
Yeah, look, absolutely. I sort of touched on my background and over 25 years investing as an institutional investor in small caps. And I've adopted a very disciplined and consistent approach to valuing the basket of stocks in which we consider for investment in small caps. So really think about industrial focused small cap companies on the ASX. And the valuation methodology we apply only 3 times through history in 25 years has had a weighted average upside of greater than 80%. If I look back at the other times in that period where we've had such dislocation in fundamental valuations, the first was the GFC we all remember that, in 2008. Second period, if funny enough, was about 7 or 8 years later, which was the 2016 credit crisis, where the risk sentiment and appetite was really off, and we saw small caps underperform during that period. And then now we're at this third event in the sort of 24-year history, 1 in 7, 8 year cycle, which has become eerily familiar. So it excites me that the fact that we're back at these points. What I can say about the 2 previous times where we saw this dislocation in valuations, over this following 2 years, we saw greater than 100% upside from the small cap market. So if history is a guide, which it quite often is, that's very interesting parameters to be looking at, and one of the reasons why we're really positive about the outlook for small caps at the moment. Secondly, the valuation differential between large caps and small caps is as wide as it's been in 20 years. And so what you've seen is that, and this is a global phenomenon, not just in Australia. So, but if we keep it with a local perspective, the ASX 100 is, especially over the last 2 to 3 years, has turned out, positive performance, up to double-digit positive performance, whereas the small cap markets, delivered closer to negative 10% returns. And so the respective valuations of large caps versus small caps, another important measure, is at 20-year highs. So again, a lot of things pointing to we're at extreme levels, and likely to see a reversion, on a go-forward basis. But what's really important is to understand the health of the underlying small cap companies, because these things aren't going to right themselves and return to more normalized relative valuations without positive catalysts. And so the 2 important catalysts are around, one, earnings growth of this universe of stocks. And now, again, we do a lot of work around assessing that. And what we're seeing is the earnings growth outlook for small caps, as is often the case, is significantly higher than that for large caps with a 2 to 3 year outlook. So we're definitely in a period where consensus, not just our expectations, but consensus market expectations are for significant stronger earnings growth out of the small cap market relative to the large cap market. The other relative measure, which is critical in these considerations, is around balance sheet strength, i.e. the level of debt or the level of cash and growth funding within these businesses. And there's a number of different measures, but consistently across these key leverage, cash cover, whatever you're looking at around balance sheet strength and net assets, again, small caps are above the average 20-year levels for balance sheet strength. So they're better than average in what we've seen and witnessed over the last 20 years. So all that points from our perspective that the health of small caps is good. The extreme disparity in the valuations are as wide as we've seen in 25 plus years. And history tells us that this typically leads to a more positive risk versus reward environment for investing in small caps over the next 2 to 3 years, which we absolutely share that view.
Well, thank you for that one. Now, obviously taking a deeper dive into the fund specifically, can you just give us a bit of a brief investment thesis on the fund, specifically the top 3 holdings, as well as what have been the top performing investments in the fund over the past 12 months?
Yeah, absolutely. So firstly, just on the type of opportunities we look for in the fund, and where, again, our experience has pointed to the ability to provide, more consistent outperformance, is looking for quality companies with genuine intellectual property. So a point of difference of these companies, which gives them the ability to have some pricing power, especially in times of inflation, which we've seen over the last few years. So we look for companies with genuine intellectual property. We look for backing strong management teams. We spend a lot of time focusing on and meeting the management of these companies, and because you're ultimately backing the team behind the intellectual property. And the other two important attributes are we're looking for growth companies. So companies that have above system growth, and typically that is double-digit plus revenue growth. And we've constructed a portfolio of 25 diversified companies where the average revenue growth across those 25 companies is circa 20% per annum. So these are growing companies. And then we also spoke about the importance of balance sheet strength. And so, we look at, are these companies profitable? And the vast majority of these companies are profitable and increasingly so, and they have sufficient balance sheets to support their ongoing growth. So that's what we look for. And we look to get a diversified exposure across the various industrial sectors, from technology to more traditional industrial businesses. So if I speak to a couple of examples, the number one holding, or the largest holding in the fund at the moment, is a company, OFX Group. Forex used to be known as, and it is an institutional foreign exchange fintech business, very much a global business that is returned to double-digit plus growth rates. And I don't say it lightly. I would regard one of the strongest management teams in the small cap market in this country. Very strong CEO and CFO with deep experience, and again they've got some really unique intellectual property around how they provide foreign exchange services from a technology platform, predominantly to global corporates, not to the residential or the consumer traveling over to Bali on a 1 week holiday. It's more handling the foreign exchange requirements of SMEs and mid-market companies globally. So business we really like. It's a circa $500 million market capitalization. We think the valuation upside is still well north of 50% in this business. And it's trading at very conservative valuation. So Forex is the current number one. The second largest holding is another one we're really optimistic about, and we all hear a lot of talk around artificial intelligence, or AI, almost a bit of a buzzword in the market, and you'll be hard pressed to find a company presentation where they don't dedicate a slide to AI and why they're going to be the next NVIDIA or whatever it may be. And our, I guess, skeptical view is not many companies are genuine plays and can really benefit from this dynamic of artificial intelligence. The one we've discovered, and we've been an investor for over 2 years now, is a company called AI Media. They do voice translation for live media production. So think of they've got major clients such as sort of Channel 7 and the ABC and global media companies around the world. Again, very much a global opportunity. But the dynamics and growth and efficiencies in the AI translation of voice to text in live production has taken a significant step change over the last couple of years. And what's really unique about AI Media is they own the infrastructure in which this translation process takes place. They actually have about a greater than 80% global market share in this critical infrastructure. So they don't need to be the individual party winning. That they use the analogy of sort of selling the picks and shovels in a gold rush opposed to up in the hill fossicking for the gold. And so a really strong platform play on a dynamic business that does north of $50 million of revenue at the moment and is, it's a global. But our view over the next 3 years is that $50 million could be north of $150 million of revenue. So they've got a significant growth opportunity and a very conservatively valued. They've got a strong balance sheet, great management team, and one we're really excited about. So AI Media is that one. And just the final top three is actually a recent addition to the fund. And it's, I guess, a good sign. Another good lead indicator for the health of small caps is a recent IPO. We haven't had many IPOs in the last 3 years because of the negative sentiment towards the space. And we've seen a couple of successful ones over the last 3 months. One that we backed and we're really positive about is a business, more a traditional industrial business called ALFABS. AAL is the code, and it provides asset hire into the mining services sector, and it's got very strong IP and machinery that it hires out. It sees significant growth and has a very strong contracted pipeline of work. But in addition to that, they've got an engineered solutions business for development and manufacturing across more globally, or not globally, nationally, across all sectors, and traditionally in infrastructure assets. So done a lot of work on major rail and road projects. And this is a business that does $100 million of revenue, highly profitable, should be growing closer to 20% per annum, and is extremely strong cash generation and very conservatively valued. We're talking about a low single-digit earnings multiple. And so very excited about that one. Only literally been listed for 1 week on the ASX. So not well known or widely held at this stage, but we think over the next 12 months it will become very well known and a lot more widely held as the underlying fundamentals come to play. So they're the top 3 holdings. I'll pause there if there's any questions on that, or I'll jump into some of our top performing investments over the last 12 months. You happy for me to do that now, Ryan?
Yeah, please do so.
Yeah, excellent. So one of the top performing ones, which is a real comparable to our fabs I was just discussing, is a business called Acro. ACF is the ASX code, and this is a business we invested and built a position sub 50 cents a share and sort of circa $100 million market cap sort of 24 months ago. This is a business that again does asset hire and engineering services into the construction sector and has an amazing track record, delivered north of 30% earnings growth for 5 consecutive years. Despite that, it was trading at very conservative valuations, not indifferent to our fabs, which I've just mentioned, low single digits. That business over the last 12 months has more than doubled in valuation and has recently upgraded earnings again. Very strong management team, really unique offering in the market, and continued strong growth outlook, especially into that infrastructure space, which is quite defensive by its nature. Again, road, rail, airports, etc. So Acro has been a good one for us. We have sold down our holding more recently into the shareholder strength, or the share price strength, but we still do hold it, and it's a meaningful position in our fund. A couple of quick other ones. Enserada, AND, is a company that, again, we had a lot of luck with, and it's really interesting example of the opportunities that become available in the small cap market. So this company recently received a takeover offer and is going through that process now. It was only 9 months ago we were buying this company again under $1 a share, and it felt like we were friendless. We were the only ones buying stock in the market. So yeah, it's a company that does data rooms for transactions. So think mergers and acquisitions or IPOs and other things. It was a technology platform that manages the data room and document storage and sharing for these large sort of institutional transactions. And again, global business, really strong intellectual property with a sophisticated technology platform powering it. It was our number one position, and then not long after that, it received a $2.50 takeover bid. We sold into that offer. The takeover hasn't actually gone through yet, but we, turned that holding into a nice profit for shareholders. But having the view of taking a 12 to 24 months view on earnings and valuation, and which you have the benefit of doing, of being a permanent institutional player in this space. And then quickly, the other third one that's been very good to us, and again, well north of 100% returns over the last 12 months, is a business called MedAdvisor. MDR is the ASX code. Still a meaningful position, top 5 position in our portfolio. It think it's a med tech business that has a digital platform for pharmacies and delivering vaccination schemes and everything else. Again, it's a business that's continued to upgrade its earnings. Revenues now, well north of 100 million, profitable, and it's again technology-enabled global business. A lot of that growth has come out of the US market and significant ongoing growth opportunities. So hopefully you can see a bit of a common dynamic with what we're holding and the winners that we've had. And we're really excited about the mix of the current portfolio we have, because those sort of opportunities are very much present in the next 12 months in this current environment.
Well, thank you very much for that deep dive. I agree that those winners are certainly highlights that are worthy of noting. Now, just in relation to the holding pattern for the investments in the fund, what is there when you go into an investment? Is there a typical holding time period that the team appears to target for the fund, or is it realistically you always have a set kind of profit, and then after that's achieved, you choose to roll out?
Yeah, look, we definitely take a minimum 2 to 3 year view on the investments we make, and again, so we do a lot of work, financial analysis and industry analysis, and meeting with management and key stakeholders in the business to form a view on the 2 to 3 year outlook, and applying a mid-cycle valuation approach on that outlook. What we see, and using that recent example of Enserada that received the takeover offer, is we absolutely, and you don't always get them exactly right like this, but when we're investing in that business under $1, our fundamental valuation for that business was $2.60. And then roll forward 6 months and received a takeover offer at $2.50. And we liquidated or sold into that opportunity, and it was only a sub 12-month holding for that core position. Okay. So the answer is we take that 3-year view. If the thesis changes because of underlying performance, or it reaches our valuation, we might sell clear. We actively manage those positions, but definitely looking out well beyond 12 months for those opportunities. And that's where the inefficiencies are, especially in the current environment for small caps.
Thank you for that clarification, Greg. Now, I'll just move on to the last question from me. So once again, if any participants have any questions, please submit them through the Q&A function on Zoom. Now, obviously, SB2 trades at a 40% discount to the post-tax net tangible assets. Can you explain the reason for that and what initiatives are in place to really just close the discount on that gap?
Yeah, no, it's a great question. And I guess it's one that creates a significant opportunity, but also it's really important to be aware of the fundamental. So just reiterating that exact position. So what we do, again, listed companies predominantly mark to market daily. So that NTA, or the net asset value, accounting for tax impact, is something that we obviously monitor daily and report monthly. And so that's a real figure. And the current share price of SB2, the LIC in which you got, is, so the rough math, just for rounding numbers, is the value of those assets are closer to 100 million, and the current share price is closer to 60 million. So there's this 40% differential. What has driven that is a structural problem within the share register. There was some forced selling from a number of the shareholders on that register, which they were not operating on fundamentals. They had different motivations on selling their investment, and so they've done that in a way which has forced down the share price and creates this opportunity. But what we need to do is a number of things. It's simply a factor of supply and demand. There's a point in time over the recent period where that supply of people wanting to sell stock was greater than the demand. Big part of doing this forum and other forums we've been doing more recently is to raise the awareness of this opportunity and to improve the demand scenario. And a couple of other initiatives are in play as well. SB2 does have a buyback in place, and that's to buy back up to 10% of the shares in the company through the buyback mechanism, because we know the value of the underlying assets. They're publicly stated as well, but that's a good use of our capital to buy shares at that circa 30-40% discount. So we have an ongoing, and we've been active with the share buyback. And it's three-factor is continuing the positive performance of the fund, and for the small cap sector, it's keeping it in place and continue to be active with the buyback and increasing marketing and raising the awareness of this opportunity, so we can correct that imbalance of selling versus buying for the underlying company. So it really is, what's important is to go into a little bit more detail, the underlying investors who have been selling initially took the investment through almost a mandated position under the government specialist investment visa scheme, where to apply for this visa program, they needed to invest in various categories of assets, including small cap listed companies. Once they get their visa, they no longer have to hold that. So it's that group of investors that have been selling, not because they've taken a view on the value of the assets or the outlook on small caps. It's just they've gone through their visa application process and have other uses for their funds. So it's a short-term anomaly, which we're working through. We're actually working through putting together a block trade of buying to clear the remainder of that selling out, and we're hopeful that will result in the company, the SB2 share price, reverting back a lot closer to the underlying asset value, which in itself creates a great risk versus reward opportunity for investors investing at this point of the cycle.
Well, I really appreciate that clarification, Greg. I'm sure current investors are going to be very much looking forward to that block trade occurring. That realistically wraps everything up on my end. We don't have any questions so far from participants. But is there anything you'd like to finish off with?
No, that's all. All I'd say is, once again, thank people for taking the time to listen. Thank you, Sharewise, for the opportunity to present. And you'll see SB2 have released to the ASX today a copy of the presentation, which I've sort of shared there. And you'll see on there you have my contact details and my colleague Yossi, who's sort of both of us are available and willing to take any additional questions you may have from today's session, or any interest you may have in the SB2 opportunity going forward. So thank you again, and we look forward to continuing the conversation.
Thank you very much for your time this morning, ladies and gentlemen, and thank you very much, Greg. This presentation has been recorded and will be posted on the Sharewise YouTube channel shortly for participants to distribute as they see fit or rewatch. And again, do as you may. Thank you very much again, Greg, and thank you very much again, ladies and gentlemen. Cheers.